it's not always going to be perfect, and that's fine. But keep going, keep going, keep going, keep going. There's always more opportunity. There's always something around the corner. So just keep plugging away.
Welcome back. Today we're speaking with Nathan Turner. So, Nathan, a little bit about his background. So, he started this company called Earnest Inc. And so, what they do is they actually raise funds and they actually go and buy residential mortgages. So, we're going to be diving into it. He's raised millions of dollars for his portfolio right now, and it provides steady cash flow as well. So, he's situated in Alberta. And so another Canadian boy, and we're going to be talking a little bit about business, real estate, and we're both kind of Oilers, Toronto Maple Leafs fans, but we were just chatting a little bit about that before we came on live, and we're hoping this year is going to be the year a Canadian team wins the cup. And but Nathan, it's really great to have you here. Thanks for coming on the show.
Hey, pleasure. Thank you so much for having me.
All right. Well, share a little bit about your background, Nathan, and what actually got you going originally, maybe after post secondary or any school that you went to. Where was the trajectory getting into buying residential mortgages?
Uh, Out of left field. Oh, that's where it came from. It
Yeah.
was certainly not the plan. My first business, graduated university in Alberta in University of Lethbridge, originally with a business degree. I had no intention of doing business. I really didn't. I took a degree because I figured I needed a degree. I figured business is something that's applicable to whatever you're doing. So that's I didn't have any aspirations beyond that when I graduated. It was a piece of paper to me. But ended up opening up a Curbs franchise. That was my first business out in Quebec because that's where franchises were available. So my wife and I had two of those out there, one, and then opened a second one a year later, which was great. And we really enjoyed it. And it was a great concept and learned a ton about business and all that. As we're doing that, started doing some real estate stuff. So we're living in Montreal. I was flipping houses out in Saskatoon, Saskatchewan. If people don't know where that is, then you're one of many. That's not a lot of people know that one. But the market was hot. The conditions were right. And so I would fly out there with a suitcase full of tools and a sleeping bag, sleep on the floor and just work like crazy for, a week or two. And then the market was such that most of the time I could sell the house before I left. So that was awesome. That was my intro to real estate.
What year was that approximately?
That was like 05, 06.
Got it. Okay.
And yeah, and if anyone started real estate in that same time, yeah, that was a great time to get started. Things were just shooting up like crazy, so it worked. And then, yeah, fast forward a little bit, I got involved with a guy originally from Calgary and moved down to the US, met up with a group of investors. They had bought all these properties out in the Midwest, about 60 properties, mostly centered in the Midwest. By fall of 2008, when everything had gone haywire, they realized that when they bought this in the spring of 2007, they bought it at the top of the market. So they ended up way overpaying for this stuff. It was supposed to be a simple flip. They were going to sell the portfolio to somebody else. Of course, that fell through. Now they're stuck with all these properties. No idea about any of them, what conditions they were, nothing. They didn't have any real estate background. They were up a creek. So they brought us in and said, hey, what can you do? So we put on our creative hats and started just thinking about how we could help really just divest of these properties. And the method we came up with was to sell these houses on terms. And being from Canada, we thought that was a brand new idea. It's not
Can you
generally.
explain what you mean by that, selling on terms, just for the listeners?
Yeah, sure. So the idea was, kind of our tagline was own a home for less than rent. So if local rent in the neighborhood is $500, pay $400 a month, but not as a renter, as a potential homeowner. So the idea is that you're paying that $400 a month, but that also then means that you're in charge of any upkeep to the property. So any maintenance, any stuff that needs to get fixed, whatever, that's not my job. That's your job because you're living in the house at a reduced amount. And that was really the general premise of it. Um, I think we even figured out early on that to charge an interest rate like the same way as the bank would do. So if the bank is charging whatever it is, 6-7%, we were charging 8 or 9%. because obviously they couldn't get financing at a bank. That's why they're going through us. So that was kind of the very bare bones of it.
Kind of like a
w-
lease to own, it sounds like?
Similar to that, yeah,
Yeah, got it.
similar to that. Um, but they were making, like, instead of flat fee going towards the principal, it was an interest rate. So we were trying to kind of model it more like a bank would do. Uh, all just making it up as we went because I'd never heard of that before. I thought that was a brand new concept. And then I got introduced into this world, went to a conference. I went to a couple of different conferences in 2009. And, the one I go in there and there's like 200 people in there all talking about exactly what we were doing, but they'd been doing it for 30 years. I'm like, really? That's a thing? People do this? And so that was
Yeah.
that was the introduction. Figured out they were called notes, and you could buy and sell these things, and there's a whole secondary market for it. So that was really my
Mm.
introduction. So, it was really just a kind of a case of right place, right time, and talking to the right people. Uh, that's the long, the long version of how to get going in there.
That's so interesting. So from that point, say from, 2000, I mean, 2008, I mean, going through that, how'd you make it through we'll say the crisis, the real estate crisis there, 2008? How did that whole industry fare?
It was fascinating. So when I got
Yeah,
started, all of that had kind of already taken place.
got
So,
it.
well, I entered in when house prices were super depressed. Everything was underwater. So the
Mm,
value of the house was less than what was owing on the property.
good
Um,
timing.
that was kind of the environment that I got going in. But what that meant is discounts were enormous. So we could buy. What it really broke down to is, and kind of we focused in on Columbus, Ohio. So I could get a property that's worth today at $50,000. The mortgage is 90, but we're not going to collect $90,000. It's just not realistic to think that. So I would buy a house basically. I roundabout. I bought the loan at probably $20,000, $25,000. So at a fraction of what the property value is, I would target empty properties so that I could do either a foreclosure, or if I could find the homeowner, having them just sign the property over to me in exchange for wiping out the loan. We got some creative things going on there of how to acquire the property for less than what we could on the regular retail market. And then we take back that property, do some minor repairs on it, just fix it up a little bit, and then do that same program where I'd sell it again on terms. So, Mr. Buyer, you're going to put down a down payment. You're going to, assume any kind of repairs that need to be done. All that's up to you now. But I'm giving you a chance to get into home ownership where you probably wouldn't have the opportunity otherwise.
So just so I understand, so you would go was the market was depressed at that point. There were people that were owing, say $90,000, 70, 80, $90,000. The house would be worth like less than 50 or whatever. And you would go to the lender and you would negotiate a deal to actually to bring that actual owing down, the amount owing down, and you would just take over the whole project, and they would get some of their money back, but they were okay with the funds that they got, and then the owner would would move along. Is that kind of the gist of it?
Yeah, essentially, the banks were selling these things at next to nothing because
Yeah,
if you think back, they had all this insurance capital that they got from government and pay up,
got it.
bonds and all those kinds of things. So really, they were just looking to get this stuff off their books.
Off the
So they're
books.
happy
Yeah,
to get, 20% of whatever was owed on it, 10%,
yeah,
whatever it was, just to clear it off and then give the
smart.
opportunity to somebody else.
What a great example of seeing a need in the marketplace and filling it.
Yeah,
That's like a really good example. It's like in any market, there's always a hungry market somewhere.
right.
Sometimes you got to look for it, and then sometimes you got to be creative. Like, how can you, put these two people together? And it's interesting that you had thought originally that you guys had creative, but there was this whole room of 200 people behind the scenes that were doing it for 20, 30 years, right? I think there's some bigger principles, general principles that we can pull from this cross industries, because there's listeners from all different industries that are listening. It's like, look, if you think you're onto something, like just start doing some research and start diving in and start going to some conferences and start talking to some people. And you'll find it pretty quick if it's a new idea, or if this has already been going on. And a lot of times you can leapfrog by actually, going and talking to people that have already done it, get best practices, learn their lessons, and then you can do like a 2.0. And it's not the first guy that comes into like a creative market generally that does, like, say there's something new being offered, is generally not the first guy. It's like the second or third guy that comes in, rips
Right.
off the business model and just does it better, more consistently.
Yeah. Yeah, exactly. Yeah, and that's when I was introduced to concepts like a financial calculator. I didn't know that existed.
Mm.
All I'd ever used in high school was the scientific to find out the cosine and the tangent and things that I'm never gonna use ever again, but the financial calculator is an extremely powerful tool. In my mind, that's what we should be teaching in high school.
Yeah, no, that 100%. So okay, so how many of these deals did you do, and how long were you doing them for, through that period of matching up?
So, and then morphs over time. So at the very beginning, it was very much about how can I get the property? How can I get the property? And then as we went along, I'm like, why am I trying to get the property so much? Like that's a lot of work. When we take back the house and then we've got to fix it, and then we've got to
Yeah,
take on all the surprises that come with that. So the more we went along, the more it's like, well, instead of targeting those empty properties, why don't we look more for ones where there are people living there? Because we can actually do a ton of good. So I'm not the bank. I'm far more flexible. Besides, I bought it at a discount, so my wiggle room is huge. So I had tons of just range where I could go in and say, look, and they don't know how much I paid for it. So that same scenario,
right.
I put 20,000 for your, the loan is close to $100,000 and the property is worth 50. And we can come up with all kinds of things and say, okay, well, property value is much less than what you're owing. So, first things first, why don't we bring it back down to what's the property value today? So, like, we were slashing these huge mortgages to bring it in line with what property's worth, just as a sign of good faith. Because realistically, there's no way I was going to collect more than that anyway.
Yeah.
So we brought it back in line with that. We can start modifying in all kinds of different ways. And arrears, what are we going to do with that? Or do we want to set that up on something short term? Can we split that up over the next 12 months and you can pay off the arrears that way? Do that with half of that, do that with a portion of it, whatever. Tack it back on the end of the loan. I mean, there's tons of latitude there. Uh,
Hmm.
if some of it if we wanted to, or tons and tons of just different whatever you wanted to do. As long as we can agree, then that's now the new terms of the loan going forward. And so it did a lot of those. So anyway, to get back to your question, hundreds. I bought my first non-performing loans back in 2010. We were creating loans before that, so that we did 30 or 40 or 50 somewhere in there of those. Started buying non-performers 2010, all the way up, four or 500. I don't know, a lot.
Yeah, yeah. That's phenomenal, and you were living in Canada at this time as well.
Right. Yeah.
So, how did you manage, this is, like, a big question a lot of investors, it's actually one of our core offerings. Like, we help Canadians invest in these large 100 unit apartment buildings down in, like, high growth markets like Atlanta and Tampa and Charleston, and so we look after all the cross-border, taxes, and they invest in a Canadian LP, and we look after the rest of it. But, like, we built the full team of 9 to be able to go and do that. I'm curious on, how did you manage living in Canada and then doing all these hundreds of deals down in the US, and then, being able to manage all of them? Was it just yourself that was doing it? And then how did you manage the cross border, like, with, taxes and regulations and all the rest? I'm curious how you handle all that.
Yeah. It was
Must
a
have been
learning curve
crazy.
for sure. A learning curve for sure.
Yeah.
As far as like, so we don't have any paid employees. It's my wife and I. We run the show, but then I've got realtors, attorneys, servicing companies, any other service that we need. There's lots of them out there, but none of them actually have to be on payroll. So I lean heavily on the locals. So I'm investing in my backyard. It's just a really big backyard. So If I'm buying a loan in Dallas, Texas, great. So now I'm going to get in touch with an attorney and a realtor to start. So those guys are set up. If I need that attorney, we'll use them. And then he'll file whatever paperwork needs to get done. Every market is slightly different, as you know, and there's going to be different rules and whatever. And so I always want to make sure that I've got somebody local who understands whatever the local laws are. And then that realtor, that's a huge key. And there's thousands of realtors out there. Um, a percentage of those are great realtors.
Yeah.
So I'm always on the lookout for great realtors who can catch the vision and see what we're doing and see that, look, there's repeat business here. We're going to keep buying in this neighborhood if I know that I've got somebody on the ground that can help me out. My kids years ago, somebody asked him what I do for a living, and they said, he just looks at a computer all day. Yeah, pretty much right. But just with the technology, it very much manageable. Just as
Yeah.
far as nuts and bolts, structure wise, when we first got started, it was a conversation with a couple of different accountants saying, so like, how do I structure this? Like, what's the way to do this so we're not dinged on taxes and whatever? And the first two both came up with these like similar kind of structures where, to me, it just looked really complicated. And you can set up the LP with the GP and the owning the 1% and on and on and on and on. And just it's this giant tree
Yeah.
structure. One, okay. So I go and talk to the third guy. I said, so is this what you guys do? And like, what are you going to charge for it and whatever? And he's like, well, why would you do that? I'm like, you're the accountant. I don't know. You tell me. He says, well, why don't you just do that all in your Canadian corporation? I'm like, well, I don't know. Can I do that? And he says, yeah, yeah, no problem. So we did that for years. We ran everything out of our Canadian corporation. We file a US tax return. We pay whatever US taxes we owe, and then pay the difference to Canada. There, with the tax treaty, we just pay whatever's left owing, which is generally more, but we pay whatever difference to the Canadian. The provincial is going to be the provincial, but the Canadian is offset by whatever we paid in the States. So
Hmm.
much easier than I thought it was going to be. It wasn't a huge deal. We had a US accountant, Canadian accountant. They knew each other. They knew how it worked. And so they worked together just to make it happen.
Yeah. And is that currently your structure the same today, or did you change that?
It's modified. So we still have the Canadian corporation and everything kind of eventually funnels back to that. Um, but like our investment fund, it's a US based entity. It's also a limited partnership, but US based. With that same kind of that more a little bit elaborate structure. We didn't get quite so crazy with what those guys were initially talking about, uh, but it's a little bit more complicated, a little bit more involved, along with the Canadian corporation as well.
Yeah, right on. Well, that's so okay. Well, so now you've created like a fund, right? So that I just there's again a couple lessons. I just want to really reinforce this. It's like do your research and build yourself a really strong boots on the ground team. I think that is like so important. And you're right. I mean, it's real estate agents, there's good and bad, just like in any industry. But when you find good people, like you hold on to them and treat them really well,
Yeah,
and they bring you opportunities as well if you treat them well. Right?
exactly.
They, of course, as a realtor, you want to do more sales, and if you have somebody that's willing and able to be able to close, you're going to baby that person in a big way. Same with the lawyer. Uh, Even if you're a Canadian buying, in the U.S., right? That's especially. I mean, even with what's going on cross border right now, tariffs and all the rest of it. I'm curious. One last question before we move on to your fund structure. Uh, how do you find these? How did you find these loans? You had like, is there like a database you go on? You just like go on the public record site. Like, how do you even find them?
Yeah, that's a great question, and that's one I get a lot. The reality is, no, there's not really a central database for it. It's so much about networking. So that very first conference I went to back in 2009, I walk in and there's all these people that have been doing this for a long time and they know what they're talking about. My goal in that first one where I didn't know a soul was to give away 20 business cards and just start the network and see, break into it somehow and get in so that people start to know who I am and I know who they are. And that continued for a long time. And the more and more I've got into it, the more and more I realize this is so much about relationships,
Mm,
where people just I'll get a call and say, "Hey, we've got these 5 loans for sale. Is this something you'd be interested in? We haven't marketed anywhere else, but I know you're generally looking." Awesome, great. So I get to look at it before anybody else. Fantastic. And that's how it works. It's really all about just back and forth with people, and then, hey, I know this guy. I think he'd be a good fit for you.
mm.
That's a huge, huge part of it.
So are they mostly just like ordinary kind of average, or do you get mortgage brokers? Are they lawyers that see these opportunities and then they're calling you, or is it just kind of random professionals?
So it's a bit of a mix. For a long time, when we were buying all the non-performing, where the people were not making payments, generally that tended to be, we'll call it institutional paper. So that was coming from a bank or some kind of lending institution. And the way that that would go is if they're looking to sell loans, they want to sell $10 million minimum,
Yeah,
10 to $15
yeah.
million. I don't have that much money. So they would sell to these larger hedge funds. The hedge funds would then look at that list and say, okay, so anything outside of this set of parameters, we don't want. So we're going to sell it off. So that's who I would contact, and that's who I became, connected with, is these guys that were looking to sell off the stuff that didn't fit in their box. And then as that's continued on, there's less of that going on now. I'm buying more performing loans. Those tend to be generally small to mid-sized operators where they're buying houses. They're doing what I was doing 15 years ago, where they're buying houses and then selling it on terms and creating a note and then looking to cash out of it so that they can go back and do it again. So I deal with those guys. And then also just kind of randomly, people will contact me either through my website or Facebook or something and say, "Hey, I've got this loan for sale. Is this something you're interested in?" I get those all the time too.
So good. Yeah, I picked up this book and it said the title of the book was your network is your net worth.
Yeah.
That's the title of the book. I'm like, oh, that's kind of a cute title, and but I think it's true. If you can build your relationships up across the board, they can really open up a lot of doors. And I've always said that one person can change your life.
Yeah.
Isn't that a cool concept to think about? If one person can change your life, like you want to get out there and try and find that
Mhm.
person if it's true. And so first you got to believe if that could be true for you, that one person could change your life. But when you hear like some really successful people, they say, "Oh, man, that person changed my life." And so you do hear that. And if you really start looking for it, you'll find that truth out there. And so I love it. So you went to a business conference and you said, I'm going to give out 20 cards, and you started to build those relationships. And now those relationships are all, paying out fruit for the work that you did early on. That's smart.
Yeah, and then the other thing we did, so 3 years ago, took over one of these note conferences that has been around for 5 or 6 years before that. Um, and, the one who's running it, she approached me and said, "Hey, is this something you'd be interested in taking over?" My immediate answer is, "Yes, absolutely." "Oh, by the way, does it make money or anything like that?" Like, because I know even if I'm not making money on the conference, that again, that network is huge. If I'm the one that's running that conference, if I'm the
Yeah.
one that stage and people know who I am that way, fantastic. And absolutely, that has been the case where now I'm getting more of those calls, more of those contacts because they're like, "Oh, hey, well, there's that guy. He's got that conference. He'll probably buy some stuff." Yep, give me a call.
Oh, wow, that's smart. Okay, so here I got a couple follow-up questions here. Now we kind of found another little gold nugget that you shared. So, how many people go to that conference a year? Like, how big is that conference? What an opportunity!
Yeah, mine averages about 200 people.
Amazing, and you're running it. You're the big cheese of the show now.
Yeah,
Okay, so you've seen some really good networking. You've done good networking. You probably have seen some that aren't so great. So for the
yeah.
listeners out there, when they go to a conference or an event, what do you think are the best practices to be able to get the most amount away from, actually you go there for a couple days, you're spending the time, you're getting a hotel, you're paying food, like thousands of dollars of investment. But the best that you've ever seen, what are some of the best practices from the best people that took the most out of those conferences?
I think there's a couple of things. So number one, if you're like me and I'm far more introverted than extroverted, I would rather sit in the corner and just be by myself and not have to chat. But that's not how the business is done. So that's not how any business is done. You have to talk to people to do any kind of business. Doesn't matter what business it is. So I force myself to like make a goal like that, 20 business cards, something like that. Something that's going to force me to get out there and talk to people where I might not be comfortable to do that otherwise. One of the secrets with that is if you go into one of these conferences, there's always going to be vendors and they're going to have their booths, they're going to have their tables set up with all those things. Those people paid to be there in order to talk to people. You did too, but they're actively looking for people to come and talk to them. So worst case, go and talk to them. And I can't tell you how many times I've gone and I've talked to all the different vendors there. And I come home and I'm talking to my wife and I say, I met these guys. Here's their product. Here's their service. Here's what they can do to help us boost our business. And then, yes, it has definitely upped the game. And then that's the new thing. And like, whether that's that one person or not, I don't know, but it's a stepping stone at the very least. And so I go and talk to all these people. When my kids were little, I would take the little doodads, whatever they're giving away, and look, kids, there's look what dad brought home. Here's a new squishy ball or whatever it was.
Yeah, right.
It was great. And so just talking to people. And then the last thing is just you've met all these people, you got the stack of business cards or whatever. You get home and then you have to follow up. It
Mm.
happens so often where people they get all this, they get home and they just get back into the busyness of every day. You can't. You have to follow up. That's the whole secret to meeting somebody is continuing conversation. One conversation is great, 10 conversations is better.
What is the kind of the typical follow-up sequence that you would recommend after the conference?
Um, I I go to great lengths to make sure that I do some kind of contact a week within the week after the conference. So if it was like a weekend thing, by like Tuesday, Wednesday, I want to get something out. And typically for me, it's an email. Um, Depending on the conversation, if maybe we recognize an immediate something that we can start doing, that's probably going to be a phone call, and we'll see if we can set something up. Ideally, if you're at the conference, be like, "Hey, let's talk more about this. Do you have time next Tuesday?" Set an appointment right then and there, so you can
Mm.
get to it and actually, force that follow up and have it happen for real. Uh, but that's my thing. Within a week, I want to be able to make some kind of contact.
That's good. It's interesting. I was just thinking all the conferences I've been on. I can't even recall maybe like one or two follow up emails after, but I don't recall like an actual phone call after. I think there was like a couple of emails, like no phone calls after have all the people that I've met. So it's interesting when you think, oh, they might, they're probably talking to so many people are following up with them. I would I would probably bet against that one. It's not very likely that there's a lot of people probably calling them after the fact and building that relationship with them. So
Yeah.
that's good, really good insight. All right, so tell us a little bit about earnest investing. So the business model, how you guys make money, and kind of what your core offering is.
Yeah, sure. So, earnest investing is the investment fund. So, we find it so much easier to manage this way. And before that, I was working with individual investors, which is great, and I love doing that. Just right before COVID, we had like 23, I think, different investors, which means because it wasn't in a fund structure, I have to keep everybody separate. So it's a different set of accounting for everybody, different
Yeah.
reporting back to everybody. And as we're going through that and doing quarterly reports, it would take like a full week of just putting all this information together, doing the emails, doing the follow up phone calls, all of that. It just took a ton of time. So it was during COVID where it's stuff slowed down enough that we're like, okay, let's take a step back, sharpen the saw, see what's going on. How can we make some changes, improvements, whatever? So it was really during that we thought, well, I knew the fund structure was out there, and I knew that was something I was going to have to do eventually. So that was the catalyst to move us forward to that, to say, okay, look, it really is so much easier for administration. On the selfish, personal side, is way easier for administration, way easier for just managing in general. Because now I'm doing one set of books, one set of accounting, all of that versus spreading it all out. On the investor side, now they're part of a larger pool. It increases safety. It increases, their predictability and timing of when they're going to get paid and how much. So it made so much sense all around. I started putting that together at that point. It took us a little while to really fully commit to that and get into it. So it's been in existence for about a year and a half. Um, but yeah, it's U.S. based. Most of my investors tend to be U.S. citizens. They either are investing cash they've got on hand for investing, or IRA funds that they can direct into whatever kind of investment they want. We do an 8% annual return and minimum $50,000 investment. It's an accredited only uh, type of investment. And I'm really confident in that 8% because when I'm buying these notes, I'm buying at some kind of a discount whenever I buy. But what it means is I can pretty much choose what my return is going to be. So minimum 12% yield is what I'm looking at. Currently in the fund right now, we're right around 13.5%. So that's where I make my money. So that, covers costs and everything else, and then also keeps me paid. So that's kind of the basics of it. That's how we do it. That's what helps me be confident in that 8%. It's not like an up to, it's not a projected. That's what we pay because that's how we purchase. So it makes it easy to do that calculation.
Yeah. No, that makes a lot of sense on that end. So, and then how about liquidity? Is there a certain minimum time frame that they need to hold their funds in there?
For us, no, we don't do any kind of a minimum hold time. If you want to put the money in and then 6, 8 months later you want to pull it out, that's fine. I would say give me about 60 days lead time. Because it's all tied up in the notes, I'm going to have to sell a note or two or whatever it is to pull out the capital and get that back out to you. That being said, just to give an illustration of how it works, and I guess I take it for granted, is notes are actually pretty liquid, especially
Mm,
to regular real estate. So, like if a regular house, you decide you want to put it for sale, you got to do whatever repairs, and you get the realtors in there to do the checks and things like that. Like you're talking easy 30 days just to get it prepared for sale. Put it up for sale, sits on the market for however long, a few days if you're lucky, up to a month, maybe more. And then it takes another month, month and a half to get closed. So, easy, you're talking 3 to 6 months by the time you decide I want to sell it to the time you actually get paid versus a note. I'll turn it around. So if I say I'm looking to buy a note, I will, identify the one that I want to buy. I put in a bid, an indicative bid. I have a week to do some final due diligence, and then it's funding. So a typical note process is, 7 to 10 days. Like that's it. So I asked for 60 days to give myself all kinds of lead time just to be sure. Um, but that in reality, that's not a difficult thing to achieve at all.
got it. Okay. So the fund structure there as well. So are they monthly distributions that come through with the fund structure? And I guess is it from day one that those distributions are going out to them?
Yeah, they start accruing right away. Depending on how long it takes me to buy a note. If it takes me, 2 weeks to buy a note, fine. But I just want to again give myself a little bit of lead time in there.
Got it.
We typically do quarterly distributions. That's what's in the paperwork for now. We're I'd like to move that to monthly. We just haven't put that in place yet. But
Yeah.
so far it's quarterly.
Yeah, got it. And then for tax purposes, it's regular income that comes in from a tax, or it would be interest income that would be paid on. Is that right?
Yeah, we're issuing at K1.
Yeah.
Yeah.
All right. Well, listen, like there's an opportunity I mean, liquidity is one thing, right? And then that it has something of substance. It's not like That's one of the things like in the market, like, and I've know guys that are like that have sat beside, brokers are like, watch this. And they come into the market and it's like, whew, they scoop out, they do one trade and it's like 250 grand that they scoop out of the market. So, I guess if you're playing that game with like trading and stocks and, there's no kind of like substance behind that versus kind of that long-term approach.
Yeah.
I think that there's it's very easy to lose, and rule number one is don't lose money. Rule number two, don't forget rule number one. In your case, you have some substance behind that, as in that note that is a tangible. Which I don't know. Call me old school, Nathan, but I love like tangible things, like real.
Yeah.
Uh, you know, like, oh, this stock is like, okay, but like what's backing that stock right now? It's like, okay, like how many shares I like, and I like to be able to um have the ability to have an impact on what those returns are, right? And so sounds like you checked a lot of those boxes. Now majority of your actually, I'm going to pause on that. So anything to add, and anything to add to kind of all the all the above that I just mentioned?
Yeah, yeah. So what I would maybe add on to that is, we take it seriously. This is other people's money. This is not mine, and so I want to make sure that I'm doing this right. So anytime that I'm purchasing, I'm always building in an equity spread. So easy numbers again. Let's say the property value is $100,000. The balance on the loan today is, call it 85. The most I would pay for that loan, even if the interest rate is at 12%. The most I would pay for that loan is 75,000. The reason being is I want to work in a minimum 25% equity spread. In case there's a turn in the market and I end up taking back the property,
Mm,
there's a protection there that we've got a cushion where I've got at least a 25% equity spread to make sure that if I am taking back the property and having to sell it, there's money there. There's still enough to get the value out of it.
got it. No, right on. Okay, so what are some of the main attributes that you look at when you look at a deal?
Mhm.
Like, is there's kind of like a checklist of things that you go through, and like, what would be the most important things for our listeners when they're analyzing deals that are really important for you? I know you had mentioned like enough of an equity spread. You
Yeah.
just mentioned one of them. Is there anything else?
Yeah, and one of the things to kind of get your head around, it took me a little while to really comprehend it all the way, is I'm not buying the house. I'm buying the financing with the house as collateral. So
Hmm.
it's real estate related, but I'm not buying the real estate. And that's really important to get your head around because you're the bank. So think like a bank, act like a bank, do what a bank would do. So when I'm looking at it, I'm looking at what would a bank be looking at? So I'm looking at what's the interest rate on the loan? When's the last time they made a payment? What's their pay history look like? Do they consistently pay? Like if their due date's the first, are they consistently paying like on 20th of the month? And
Mm,
that's not necessarily a bad thing, but I just want to know, like, what are the habits? What has been put in place? Like how are these people habitually making payments, and just understanding what the story is behind it all. Um, where is it located is a big part of it. If it's in New York, that's very different than in Texas. Foreclosure law, if I end up having to do a foreclosure in New York takes forever, like
it's like you're
minimum.
evicting a non-paying tenant. It's like just like
Yeah,
in Ontario, it's 12 to 18 months, whereas the
exactly.
markets that we're in is like 1 to 2 months. So I get that. That
Yeah,
that makes
yeah.
sense.
Foreclosure minimum 2 years in New York.
Wow.
Texas, you can get it done in 3 or 4 months. So it's a difference. So I want to make sure that we know
Wow.
what's going on there. Cook
Wow.
County in Illinois, forget about it. I've got a whole situation going on there that we're trying to clear out. Like it's a nightmare. So stay away. But you don't know unless you know. And so all those kind of criteria go into it. Yeah.
Nathan, what are the markets that you love? Like, are there kind of like these are like the top five that you generally like to be in?
Yes. Texas is definitely number one. A few reasons for that. Fast foreclosure, like I said, if it needs to come to that, then we've got a relatively easy out. It's also a pretty strong market. We don't see a ton of fluctuation there, even during the big recession. So that's a big one. The other thing that I really like about Texas is they do a lot of seller financing, and they'll either call it seller finance or creative finance or seller carryback, or they'll use some kind of term, but all of it means the same thing. It's that same thing where a person owns the house. Now they've sold it on terms, they've created a note. That happens more in Texas than any other state. So there's a lot of those out there as well. Texas seems to be more savvy when it comes to those kinds of things, and so that's an easy one to deal in. Outside of that, Tennessee is great. Missouri is actually really good, one that people don't think about very often. Um, North and South Carolina, I like. Not everybody does, but I like them. It's more those are probably my top 4 or 5. Um, New England, anywhere, Rhode Island, Massachusetts, the news, New Jersey, New York, New Hampshire, tend to stay out of those areas. Again, because foreclosure laws there are just weird, and they have some funky little things that they try to do that just make it very difficult to deal in.
Well, how about Florida? What are your thoughts on Florida?
I like Florida. For when I first got started, Florida was so backed up that I stayed away from it for a couple of years. Um, Backed up meaning, again, I was dealing with non-performing loans, and if I was doing a foreclosure, it was easily a 18-month to 2-year process. As they kind of cleared that out, it got down significantly. Now, today, if you had to foreclose there, you're looking at 6 or 8 months maybe. So it's significantly faster. In general, I like Florida. To me, it's a little bit of a canary in the coal mine. It tends to fluctuate before some of the other areas do, so that I keep my eye on it.
No, it's really good insight, and especially looking at it from a perspective of like a lender. So it's different. You're right. You're not buying the dirt. You're buying the loan, and the dirt is collateral, right? So interesting insights there on different marketplaces, and the speed of which you can foreclose if it gets to that. What percentage of these would actually go into foreclosure, where you actually need to take that next step?
Yeah, good question. So, partially it depends on if it's occupied or not. If it's not occupied, either they've abandoned the property or they've passed away, they've died. In those cases, pretty much 100% of the time, you're going to have to do a foreclosure.
Hmm.
If it's occupied, almost the total opposite. It maybe 95% of the time we can work something out. We can do some kind of modification to the loan, and we can figure out some other way to get them back on track making payments. It's really rare to foreclose on a person. Usually it's an empty house.
Right on. So if say you take on 100 of these, like how often you have that buffer in there, which is it's like, listen, if you got to go through it, I'll look after everything. I got a buffer in there.
Mhm.
But say you take on 100 of these that you go through, what's kind of the percentage, the fallout rate of going into foreclosure?
If they're all occupied and I bought them as performing loans, typical typical default rate, meaning they missed one payment, is about 5%, between 4 to 6
Hmm.
typically. So 4 or 5 or 6 of those will default in any given month. Um, of those that actually get to foreclosure, like maybe one.
Yeah.
It's pretty rare. It
I
doesn't
would
happen.
imagine, yeah. So about 1% approximately of these will actually go into foreclosure. But even in those ones that go into foreclosure, there's buffer there. You just hope that the market doesn't take some sort of downturn to be
Right.
able to eat that up. But I don't see, like, right now in the market, there's a lot of markets that have dropped already. It's interesting in the multifamily space right now. Like, there's very clear evidence and data that we've now hit the bottom. Like, we've seen 20-30% drops from the peak of the market on increases in cap rates, but drops in values.
Okay.
And this is like a very exciting time to be buying. And isn't it so interesting, Nathan, that when it's an exciting time for real estate investors to buy, the rest of the market thinks it's a very, very scary place or unexciting
Yeah.
time to buy. Like, it's more exciting when the market just went up by 30% and all their friends and family are telling them they're geniuses, keep buying more. But when the markets come down, real estate all of a sudden it's like, oh, why would you buy this? Like, why not? Everything's at 20-30% discounts. And this is where like I'm like being very like encouraging with our
Mhm.
investors is like, this is a phenomenal time. We've seen pricing come down. There's been very little new inventory coming on the market, or that's being built over the last couple of years because developers have been sitting on their hands.
Yeah.
And so next couple of years, there's like, there's very strong rent growth projected based on, very little new supply coming on in the next couple of years. So I would imagine for you as well, like you're looking at all these and you're like, man, like the downside on this is quite low right now because pricing's already come down. You already got it at a discount and you're getting it at a further discount as well. Is that what you're seeing?
Yeah, that's exactly it. And to your point about, the multifamilies, and like you say, the contractors have been holding off for a little while. That's
Yeah.
perfect. The other kind of loan that I buy are the short-term loans. So as that continues to ramp up here over the next couple of years and people are looking for those 12-month, 18-month loans, I buy those too. So somebody, same kind of thing, somebody will create a loan to somebody who's going to do a fix and flip or something. Looking for that liquidity, they'll sell that loan off to somebody like me, and then they can go back and lend more money. So yeah, it's an exciting time for sure. And there's always more money to be made.
So just before we get to the rapid fire, what investing advice, just overall investing advice, would you give the listeners when it comes down to, investing as a whole?
My advice, I guess, for investing specifically is do your homework, but don't get stymied. And I've seen this in my own family where, yeah, my brother who has done all the research and he's I don't know that he's ever invested in anything because he's done so much
Right.
research on this, that, and everything else. But then he just, starts spinning in circles and never
Right.
actually puts any money into whatever it is. And then,
Yeah.
he's following it and then, "Oh, if I'd invested 6 months ago." I'm like, "Yeah, if you had, but you
Yeah.
didn't."
Yeah.
So do your
Yeah.
homework, but then do something.
Yeah, it's so interesting you say that. The amount of people that I've seen through my career, we've sold on our brokerage side. So we got an investment firm, but then we've got a real estate brokerage north of Toronto. So we've sold a lot of properties. But the point there is that the number of buyers that said they were going to wait for the market to drop
Yeah.
and they didn't buy, they're still waiting. And unfortunately, like prices have like they've doubled and they're still waiting and I'm gonna wait for but the thing that's really interesting is that I only laugh because the not because they didn't get in. I kind of laugh because when you start looking at all the data points, the data will tell you the truth. If you start listening to the news, you start listening to YouTube, these guys, it's like these doomsday, it's like it scares you to take any action, but the action of not taking action is an
Mhm.
action and you're losing guaranteed because there's inflation. And so you see like, 3% inflation. That means your value of your dollar is going down 3% every year. And that's just what's posted. You go to the grocery store. I mean, it's bigger, I think, than what they're advertising. Like everything's getting more expensive. So you really got to hold your returns more accountable.
Yeah.
I think in today's market, and you got to move on it because actually keeping cash in the bank, you just got to know that it's losing and eroding its value.
Yeah. So
Yeah,
take action, do something because
take
it's
action. Yeah, that's good. That's really good. And it's interesting. A lot of the entrepreneurs that I work with, they're massive action takers. Like, they'll do all their due diligence. They'll go deep. They'll extract information very quickly, and then they make a decision. And that's actually something that I've seen some of the most successful people that I've spoken with. They make a decision fairly quickly, and then they hold their decision for long term. And I've seen
right,
unsuccessful people take a long time to make a decision, and then they change their mind very quickly once they get in.
right.
And so, definitely do your due diligence, but taking action is really important as well.
Yeah, then decide and do. Yeah.
Yeah, that's good. Good insight. Very, very good. Good advice. All right, Nathan. So we're in rapid fire part of the conversation. You ready? I got three last questions. And we're going to wrap it up.
Okay.
Okay, so I'm a big reader. I love reading. Which book for you has made the biggest impact in your career?
So many. Let's go with Rich Dad Poor Dad. That has
Oh,
been a great.
good old classic.
Yeah.
Three words that best describe you. Maybe a friend or family member that said, "These are the three words that best describe Nathan." What are they?
Kind, fun, and um, adventurous.
Yeah, cool.
Yeah.
All right. And final question, what final advice? So there's entrepreneurs out there listening today. You just gave some good advice about, take action,
Yeah.
do your due diligence, take action. Is there anything else, last kind of remaining like nuggets, and it could be about anything that you'd like to share with the listeners?
I mean, for the entrepreneurs in particular, just keep going. This is we're all entrepreneurs. This is who's listening to the show is people that are willing to work for themselves. It's not always going to be perfect, and that's fine. But keep going, keep going, keep going, keep going. There's always more opportunity. There's always something around the corner. So just keep plugging away.
Amazing. Yeah, great advice. You gotta have that grit to keep going and get past those challenges, because those challenges make you grow. They're good for you if you see them that way. They're little growth pills that you can swallow. You just got to keep moving for it to work. So, Nathan, how can the listeners reach out to you? If they have any questions about your offering and connect.
So best thing to do is go to the website. It's earnestinvesting.com. And there's more information about note investing there. There's a link over to the conference that we do every year if you're interested in doing that. And then the contact me is on there as well. And that's the best way to get a hold of me. I'm more than happy to talk to you. So please, yeah, go ahead and set an appointment, whether it's about note investing, entrepreneurship, whatever. Banff and what to go see in Banff. I'll tell you.
Amazing, Nathan. Thanks so much for coming on the show. Really appreciate your time.
Hey, pleasure. Thank you.
Right on. Well, thanks for listening, everyone. If you enjoyed the show, you can go ahead and subscribe to the channel or share it with another high net worth entrepreneur that you think would benefit from the show. And just remember that the fastest way to build your wealth is to grow your business and invest in real estate. I love you guys.